Even Fed has uh, cut the interest rates during this period. The second important factor is that the demand environment in India has remained uncertain. We had very harsh summer followed by prolonged rains, which even now continue in several parts of the country, which is likely to affect the performance of corporate during 2Q. Rural side is looking better, demand is improving, uh, and the government has also given some incentive to farmers. They have listed some export restrictions, increased the MSP, etc. So rural side is definitely looking better. In the past few weeks, if you look in particular, the recent election victory of the ruling party in Haryana has been taken very positively by markets. But in the next 3-4 months, we are going to have Maharashtra, Jharkhand, and Delhi, which will actually set the tone how the political scenario is panning out for the next say at least for a year or two. So we we are in the current scenario, we are looking at, say, your demand scenario is mixed. GDP growth in India remains very favorable. The capex push from the government with regards to infra, PLI, etc., remains quite robust. And the geopolitics is something which we need to watch out for. Now, two to three things which you can say, looked at here. One is your US elections, which are, you can say, happening this year. So we have tried to compare the two scenarios. You can say if the government in US changes, if the new party comes, then there is likely to be more inward focus, more focus on, you can say, the US corporates, the local demand, local production. There could be some impact on your US visa, uh, the US visa allocations. And so, for example, from India's viewpoint, particularly important will be the H-1B visas because they are very important from the IT services exports, which are backbone of the Indian economy. And the second could be defense, because India is facing a very rough environment on its border in the past 2-3 years, and we need much more arms and armaments. And there are certain important deals which are, you can say, underway between, you can say, India and US. And I think recently we have signed a deal to acquire some drones. And we are looking out for sourcing some critical components and armaments for US, which could be very important from the safety and the security viewpoint. On the healthcare side, I think both the you can say parties are indicating more inward kind of a scenario, some sort of revisiting their entire your public mediclaim under Medicare, and the implications could be, I think, that there is not likely to be any negative impact on the same for the Indian companies or the India as a country. Now, rural outlook, as I said, it is improving. Monsoons have been good. Water reservoirs have been better, except in a few states. For example, you look at in north, particularly your Punjab, in east, a couple of states, and down south, I think. So hardly 5 to 6 meteorological subdivisions have not been good. Otherwise, rains have been quite satisfactory in the current. In addition to it, I think what is also happening is that the government is trying to increase the rural income. So what they have done is, for example, to you can say help farmers, they have uh, removed the price cap on non-basmati exports. Similarly, onion exports, which were banned, they have been allowed. And also the duty on the edible oils has been increased. Although these measures are likely to be inflationary, but it will go a long way in improving the situation of the rural India. And in fact, if you look at, say, recently, even the Manrega wages are higher by 15 to 20% YOY, and the Manrega demand is going down, which indicates that the rural India today is in a better shape than it was, say, a year back. Now, one important factor, I think, which we as an Indian should be very watchful of is electoral populism, which is actually sweeping India. If you look at what happened during Lok Sabha elections or what is happening now in the state elections, so some sort of, you can say, the monthly paychecks to all the women, to farmers, and to the various sections of the population, they are being announced, which range from free bus rides, free electricity, free scholarship, and all that. So although you see the welfare state has been something which Indian constitution also, you can say, aimed for when we assumed independence, but at the same time, if you look at what has happened recently, even a rich state like Karnataka, because of the freebies which have been announced today, doesn't have enough funds to go for the various infrastructure as well as the developmental projects. Similarly, the states of your Himachal Pradesh and Punjab, they have also been under considerable pressure. So populism is something which is already impacting the fiscal situation of states. And if you take it on a national basis, if every state starts doing that, so eventually, while it will promote some sort of, you can say, consumption because money will be going in hands of people, but it can have detrimental impact as far as the overall fiscal considerations are concerned and overall your money to be spent on the development that is concerned. This is a model portfolio which we run, and this model portfolio, since its inception, has actually outperformed Nifty by around, I think, 23-24%. And last time around, it has done better than the overall market. And in this model portfolio, we continue to be very constructive on automobile, banks, cement, construction and engineering, uh, consumer more on the discretionary side, and healthcare. So IT services we earlier used to be underweight, but now we are equal weight on the sector. So this is what I said, 23.5% outperformance from Nifty since inception. And since our last report, it has outperformed by 0.9%. You can say some of the sectoral views, like I said, automobile, we remain constructive. Rural demand is looking good, and M&M and Hero MotoCorp are the good plays on rural India. And additionally, Maruti, which has not gained so far in the entry-level segment. So that should incrementally be doing good. So I will take consumer also. Consumer, we are actually reduced our weights, overweight in that sector, but we have cut weights more on the staple companies, where on the discretionary side, we remain positive. We have increased our weights on Astral and some of the other companies like your Interglobe Aviation is there, and some of the other discretionary names, we remain quite constructive and positive. Now I will ask my colleagues to take some of the other sectors one by one.
Yeah, hi, am I audible? Yeah, Amit Anwani this side. So, broadly, I'll talk about few pointers on capital goods and defense. Broadly, with respect to talking near term, we are looking at pretty strong volumes to continue in electrical component, power equipment, and broadly, I feel that defense, power, and some parts of mobility, including high speed and metro, could still see pretty strong growth. And we are getting a lot of strong fillers for bioenergy as a space. There's a lot of announcement which is coming in. We saw the sugarcane notification got revoked, and the impact will come from next quarter. So broadly, thematic wise, we are looking from where the demand and volumes will be strong. We are looking for energy transition, bioenergy, power component, electrical equipment, including transformers and conductors to see strong growth. And this year, we are expecting that all these component companies could see a double-digit volume growth, and largely the intake would be back-ended in that aspect. So going one by one, so we are feeling that, for example, in my coverage, Voltamp can deliver pretty strong volume growth this year as well. On transformers, APAR, we are still feeling the numbers will be pretty strong. High-speed rail, we are seeing some developments happening. Very recently, BEML got some order to develop the prototypes for high-speed rail. So we are seeing a good future for high-speed and metro-oriented companies, including BEML. Bioenergy, I'm pretty positive on Praj with a longer-term view. I'm expecting that, including the notification on biogas and the way they are also diverting towards green hydrogen export in process equipment can really play well. So broadly for this quarter, we have given Bharat Electronics, Praj, Voltamp, APAR as a top pick. And we feel this year intake-wise would be back-ended. Q3, Q4 could see the intake. We feel, as I said, the sectors, including components, power component, electrical equipment to have double-digit growth. We can see some pressure on the EPC companies where the labor shortage impacted Q1, and I feel Q2 will also be impacted some bit for KEC, Kalturu, L&T, and a few other EPC companies. So broadly, that is the area where we are neutral to kind of not very optimist, but I think rest I explained. So I'll wait for any questions to take. Or maybe we take the questions at end. Now I'll hand it over to Karan to discuss on pharma.
Video I can't open. Yeah, hi, this is Param here. This is Param here. I cover healthcare sector. So to start with, on the pharma side, we expect a very strong quarter in the Q2 on the pharmaceutical side. From a coverage unions, we estimate around 18 to 20% kind of EBITDA growth. Both the key geographies like US and India looks pretty healthy during the quarter. If I touch base upon the US, some of the key products which is contributing since last quarter, that will again contribute even in this quarter. Products like Revlimid, Spiriva, and some of the other meaningful launches will continue to contribute in a meaningful way for some of the companies in this quarter per se. On the domestic side, though the acute season was pretty strong, the IQVIA data does suggest that the industry grew between 7 to 8%, and some of the companies should outperform by 100 to 200 bips. So even on the domestic side, the growth was pretty much steady, and that should contribute between 9 to 12% for most of the top 15 to 20 companies. If I touch base upon below revenue, the API prices continues to be benign. The overall, which will continue to benefit the formulation companies. So even from a gross margin perspective, the quarter should look pretty healthy and will continue to improve even from a YY perspective. Beyond this quarter, if you see overall in the last 2 years, the US is predominantly has been pretty steady. We have seen due to the drug shortages or because some of the facilities been stuck with the US FDA, which has benefited the Indian companies. We continue that trend will continue. The inflationary scenario will continue, though this is more like a product specific, but we are seeing most of the companies, Indian companies, which are FDA compliant. I think they will continue to benefit in terms of regularly timely new launches. So US will continue to remain steady, and the companies which will have a better pipeline and where the facilities are pretty much clear will continue to outperform than some of the other names. On the India side, I think next 4 to 5 years, though the generic and trade generic and generic volumes are being increasing, but the prescription market continues to remain steady. Still, the out-of-pocket expenditure continues to be on a higher side. So overall industry growth 6, 7 to 8%, I think will continue. Largely will be a function of say volume and in the new launches. And the top 15 to 25 companies from our perspective will continue to outperform the domestic market. So both the key geographies, US and India, we continue to remain say positive, and I think will continue to drive the earnings from the next 12 months perspective. And as I said, this quarter continues to remain pretty healthy in the overall pharma context. If I touch base upon on the hospital side, seasonality wise, this is an extremely strong quarter. Overall, we estimate around 18 to 20% kind of EBITDA growth. Both the occupancy will improve on a sequential basis. Even on a YOY basis, some of the companies should report improvement in the occupancy. The ARPOB also will continue to remain pretty much steady. Most of the companies should report between 5 to 6% plus kind of ARPOB growth on a YOY basis. So that will percolate to the EBITDA. And more important, structurally, if you take beyond this quarter, next 2 to 3 year perspective, the growth in this sector will be largely a function of the new bed addition. And most of the companies are almost adding, say, 60 to 60% to 100% bed addition in the next, say, 3 to 4 years. And more important, the bed addition, what they are doing is largely on account of not only greenfield, it is a function of more of a brownfield, inorganic, as well as greenfield, which would not drag the EBITDA, which was the case in the last capex cycle. And despite my capex intensity going up, my balance sheet and everything remains pretty much healthy. So overall, we continue to remain positive both on the pharma and on the healthcare side, and the sector should continue to outperform, which has been the case in the last few quarters also. Yeah, thank you very much. I will pass it on now to my colleague Gaurav for the banking.
Yeah. Hi, everyone. This is Gaurav Jani. I look at the banking sector. So just, firstly, wanted to sort of highlight a couple of sector trends, right? So clearly, I think loan growth is sort of sustaining at about, right now, the numbers look like about 15% YOY system loan growth, and deposits seem to be accruing at about 12% on a YOY basis. The way to look at it would be that from a 2-3 year perspective, I think loan growth should settle down somewhere between 12 to 14%. That's number one, and deposit growth will catch up. So from a system LDR standpoint, it looks like somewhere between 77 to 78%. I don't think it'll surpass 78%. The 78% is the system LDR peak that we are looking at. So that is number one. Secondly, what I understand from the RBI governor's speech is liquidity is positive from the last 2.5 months. So that should bode well from a wholesale deposit cost standpoint. And what I mean is from a margin perspective. All these indicators are actually pointing to go now overweight on the sector. Most of the negatives have already been priced in. Assuming that rate cuts would be about 50 to 75 basis points in terms of repo. I think once we roll forward to FY27, we're looking at a stable set of bank earnings, right? So clearly that's the broader stance. Would continue to prefer large private banks versus PSUs. And in terms of core earnings growth, 27, I'm looking at about 15% broadly for large private banks versus high single digits in FY26. What I mean is clearly loan growth in FY27 would translate to my earnings growth. That's number one. Plus margins would also stabilize in FY27. That is what I was alluding to. So in terms of preferences, as I mentioned, we prefer the large private banks, ICICI, HDFC. Just want to highlight a couple of other names. IndusInd is what you can look at, once they actually declare the Q2 numbers, because there is a certain overhang. But I think most of the negatives are already priced in. So that's one other stock which you can also look at. So that's broadly on the banking sector. Quickly, from a quarter perspective, I'm looking at some bit of margin compression coming through. I think majority of the compression has already come through, but I'm still looking at about a 3 to 4 basis point margin compression broadly. Outliers would be HDFC Bank and Federal Bank, specific to the quarter, I mean. Nothing much on asset quality, just that asset quality on a QOQ basis, should sort of improve in terms of slippages. But I think provisions would remain stable because, aging-based provisions would sort of come through. So that's broadly on the sector. So my view is turning positive with an overweight. Would like to conclude on that. happy to take questions later. Thanks.
Yeah, so if we look at, say, the Nifty contributors as far as your sectoral EPS is concerned and the growth rates are, then, for example, banking, cement, metals, and technology, these are the four sectors which are likely to provide, you can say, double-digit growth. And so is the consumer as a sector. Healthcare, this year, the growth rates are likely to be very good. And over the next couple of years also, the growth rates are likely to be steady. Now, if you look at, say, Nifty, your earnings, there has been, if you look at, say, the consensus, there has been a cut in the Nifty estimates by 2.2% for FY25, 3.3% for 26, and 4% for FY27. As far as our your PL estimates are concerned, our estimates are also seen, you can say, little bit of cut over here. And our estimates are actually lower than the, you can say, consensus estimates. Now, if you look at the valuations of Nifty, you can see the dark line shows the 15-year average, and currently we are very close to the 15-year average. So it's a slight premium, but more or less in that range, say 1.5% premium, which shows that the market is not cheap, but it is not, you can say, very overly expensive also, if you look at the long term. Now, this time around, we have introduced FY27 EPS for Nifty at 1547, which EPS has seen a cut, as I suggested, 3.8 and 2.8%. And if you look at, say, the overall earnings, I think we are looking at, say, double-digit kind of an EPS growth for the next 2 to 3 years. Okay, now, if you look at, say, this is the, you can say, your first half performance, but the critical, you can say, factor to watch out for here is, first of all, that hospitals, pharma, capital goods, chemical, they are likely to report strong growth during the current quarter. Auto, banks, and durables will also show double-digit EBITDA growth. As I said, rural demand is showing signs of recovery, but at the same time, discretionary spending on travel, housing, etc. So that remained effective. So if you look at, say, overall economy in general, the second half should show some bounce back in the capex spends as the election euphoria gets over, the ordering which is happening from the past, say, quarter or so, so that starts getting implemented practically. And also, I think from the demand perspective, this is going to be the most important quarter, if you ask me, because we had you can say, the festival season has set in. We had very few marriages in the first half of the year, particularly after the month of, say, April, or say maximum middle of May. So we hardly had any marriages for the last year, 5 months or so. And now the marriages will start post 15th of November. And usually during the wedding season and the festival season, there's a significant pickup in demand. And this time around, if you look at the market estimates or expectations, a lot of optimism is being built into both rural demand as well as the urban discretionary spend led by marriages and events. Now, that actually is a big risk to the markets also, because if you look at, say, past couple of years, it's not that always the expectations can be met. And if particularly during the current quarter or, say, period from around, say, 15th of November to middle of January or late January, if the demand during those periods is slightly lower than what the analyst estimates or what the street is anticipating, we could see some cut in the earnings for various sectors as well as for Nifty as we particularly we need to be watch out for what happens on the inflation front, because if you look the past, say, month or two, the food inflation has shot up. And as I said, the government has relaxed the, you can say, export of onions, increased the duty on edible oils, even the prices of tomato and vegetables, they are moving up. So food inflation is likely to remain elevated, which has direct bearing on the interest rate cuts by RBI, because people are earlier expecting October. Now it has not materialized. Now the next hope is December. But if the crop output, particularly for the fresh produce, gets impacted due to unseasonal rain, which still continue in the October as the monsoon is prolonged, then there is a little bit of possibility that the rate cuts might get postponed from December to even January, Feb. Okay, so these are some of the stocks which we have put in our conviction list, which includes say Ambuja Cement, Bharti Airtel, Bharat Electronics, HDFC, two banks, ICICI and IndusInd, then your Interglobe Aviation, L&T. So I think these are, you can say, all across large caps. Large caps have done well. They are actually, earlier they were significantly underperforming than mid caps and small caps, but now the gap has narrowed down considerably over the past 3-4 months in particular. When it comes to say mid caps and small caps, then we are having BEML, Crompton Consumer, Cyient, JB Chemicals, Jindal Stainless, Lemon Tree, RR Cable, and Safari Industries in that. So I think that's it from our side. We'll be happy to take any questions. So any questions you can actually send in the chat box. The first question is regarding the Q2 earnings. So as we said that the Q2 earnings, if you look at on an aggregate basis, so the sales growth of our coverage universe is likely to be, you can say 5% odd with flat EBITDA and decline in PBT, mainly because of the oil and gas sector where the cut in the earnings will be sharp. So excluding that, we are estimating 6.6% growth in EBITDA and 10% in PBT. So the earnings, I would say trajectory will be mixed. It will be showing the impact of some pressure on the discretionary spend. Some, you can say, delay which has happened in the overall capex spending by the government, and also the impact of, you can say, very prolonged rains and as well as your floods in certain parts of the country. So the next question is that how do you see the broader markets considering sky high valuations as compared to the average of the past 5 years? Okay, you see, last 5 years might not be, you can say, that truly representing the entire scenario for the simple reason that FY21, FY20 to some extent, and 21 and 22, they were actually the COVID years. And during the COVID years, actually, we saw a lot of variations and fluctuations which happen on the earning side. So that is why the FY23-24 was actually the first year where you could actually see the normalized earnings. And that is why I think last 5 year average would be something one would avoid. That is why we are looking at actually last 15-year average, and markets today are trading at 1.6% premium to 15-year average, and we are actually valuing the Nifty on last 15-year average, which is, you can say, 19.1 times, which has given us our target, which we have actually written in our report. What is your target for Sensex and Nifty by March 25? You see, we usually give the target for Nifty and not the Sensex. And our earlier target for Nifty was 26,820. We are valuing Nifty, as I said, on last 15-year average P multiple on September 26, and we have revised our target in the base case to 27,867. Okay, so the next question is that can you elaborate the impact of prolonged rains? Okay, so you see, what actually happens in case of monsoons is that monsoons always set out from Kerala and then they gradually spread throughout the country. And in terms of withdrawal also, the withdrawal first starts from north of the India, and then it actually, can say, gradually withdraws from the central part of the country. But during the winter season, we also have the cyclonic, you can say, monsoons, which are called the winter monsoons, which happen in parts of, say, South India, particularly states like, say, Tamil Nadu and parts of AP, and also some parts of North India, that is, you can say, Punjab, Haryana, etc. Now, this time around, even while the monsoon withdrawal is not full, you can say the winter monsoon over Tamil Nadu, they have already started. Now, the impact of prolonged rains happens on several fronts, and I think the biggest impact is that a crop which is standing in the field, which is ripe to be harvested. So, if you have torrential and very heavy rains and thunderstorm during this time, so there is a very serious threat for the crops getting damaged. So it includes all your seasonal crops, like, for example, vegetables and all, and it also includes, you can say, crops like, for example, whether it is cotton, whether these are oil seeds, pulses, and paddy, which are today standing in the field, because at the time of ripening, you actually don't need, you can say, too much of rains. And the impact of this could be that if your crops get destroyed, then there could be impact on the food prices and your food inflation could go up. That is one. The second, the entire construction activity, which includes infra, which include housing, also gets, you can say, delayed. Painting activity gets delayed. And I think the overall economy in the near term could be detrimental due to prolonged rains. So we don't have any more questions. We will wait for, say, 30 seconds if there are, you can say, any further questions. And otherwise, I think I will hand over to Rucha to, you can say, conclude this webinar. Our Nifty target is for 12 months because we are valuing it on September 26. We are today in October. So it's a 12-month Nifty target based on September 26 earnings. Okay, you see, FI buying and selling has been very sporadic. For example, if you look at, say, FY 23 or rather calendar 23, the FI inflows were on the negative side. Even in the current year, or you look at, say, past couple of years, the markets are driven more by the MF as well as your DI inflows in India. Now, if you look at, say, the reason for their selling, so there could be, say, multiple reasons for that. But having said that, India is being seen as a relatively expensive market in comparison to some of the other economies or you can say, both developed as well as emerging markets. So that is one. The second factor is that the China has given stimulus and a lot of hope is being built that the economy of China will recover and the growth rates will go up. So there is some sort of, you can say, money being shifted from India to China and some of the other economies. So that might be one of the reasons that there has been FI selling in the last, say, 10-15 days in particular. Yeah, the Nifty target, as I said, it's a 12-month target. So it is a target for October 25.
Thank you so much, everyone, for attending our webinar. The press release has been shared with all of you, and we'll be sharing the webinar recording as well. Thank you.